I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul de Sousa, Senior Vice President and Investment Advisor at Sightline Wealth Management. Thank you so much for being here today with me, Paul.
You're welcome. Thank you for having me.
Great. So, since it's our first time speaking together, I wondered if you could start by giving me a brief introduction to yourself and what you do at Sightline Wealth Management.
Sure. I'm a Senior Vice President and Investment Advisor at Sightline. We're a private wealth firm focusing on investments and portfolios for high net worth clients. And as part of that, we utilize an open architecture, more of an endowment approach with a healthy allocation to alternatives, one of which that allocation is also precious metals. And our portfolios range probably a minimum of $500,000 and up for our clients.
Okay, perfect. So we're here today to talk about physical precious metals. And I want to start asking about the role you see physical precious metals playing in investors' portfolio. So why are they an important component, and what might be the right amount to hold?
The role is capital preservation and purchasing power preservation. Gold is limited in supply, and with the amount of money that's being created around the world and in gold's historical use as money and as a currency, it should be a foundation of everyone's portfolio, anywhere from about 5 to 10%. Investors should look at it as a long-term holding. Stop focusing on the price, stop focusing on the volatility, stop focusing on the macroeconomics supporting it. I find, doing this many years now, I find precious metals investors to be looking for the news that supports their investment in metals, and hoping for bad events to outcome so that the price rises. So I think that's the wrong approach. I think it should be literally look at it as the foundation of the portfolio. As if you're building a house, the bricks of gold represent the foundation, and all of the financial assets rest on top of it. In the case of worst case scenario, things burn down, the foundation's still there, the gold is there. I spend a lot of time up front discussing that with my clients, a lot of time before they make their first investment, and to the point where they look at, when they receive their quarterly statements, they're not focused on the price. They know this is something that's going to be an extremely long hold, and they worry about all their other investments and not their gold. So long answer to your question, it should be absolutely part of everyone's portfolio. Has to be bullion, and has to be the correct type of bullion as well, in terms of how it's stored, and not a proxy for gold, but it actually has to be physical gold.
Okay, perfect. That actually sets it up really well. Maybe you could tell me a little bit about the right type of bullion, and maybe also you could talk to me a little bit about what types of precious metals investors should look at. I know you've been talking about gold, but silver, platinum, palladium are other options, and I wondered where you stand on those metals as well.
So the right type of bullion is, so you have to consider yourself as an investor. You mentioned the word investor. So an investor has to assure themselves and ascertain that what they're buying is actually gold, allocated gold, not a promise of gold. If you're a speculator, you don't care what it is, you're just betting on the price. So you can use various ETFs for that, or other investments. Short-term trader, you don't care, you want to get in, get out according to price movement. But as an investor, and one that wants to hold ounces, there's many options out there, but you have to understand the fine print of these investments, in terms of, does the custody agreement actually ascertain that there is gold? Is it allocated? Is it insured? Whose property is it? So you have to assure yourselves of that. Now, I know many investors want to own old coins and hold it themselves because they distrust the financial system, the monetary system. Again, I've been dealing with individuals on that topic for over 20 years now. And the simple answer for that is, sure, hold some in your own personal possession. Hold as much as you're comfortable losing, in terms of, there's a lot of cases where investors want to have that pirate mentality, where they want to store, stash their wealth in the ground, bury it, what have you, for various reasons. And It just comes down to, fine, do that. I can't talk you out of doing that, but again, only hold as much as you're prepared to lose. And then that kind of goes down a whole nother topic too, because individuals think, well, the U.S. government or the Canadian government may expropriate gold. Therefore, if it's held in investments, I won't have it. But the same thing will happen if you own it physically. If it's expropriated, it won't be legal to own. And so how will you part with it? So in terms of your part two, silver, platinum, palladium, yeah, they're all precious metals. None have this long history of monetary gold, as a monetary asset as gold does. Silver, yes. Platinum, partially. I consider the rest more industrial metals. So I don't, although invested in the past, I don't look at it as the core foundational part of a monetary asset of a portfolio. So, maybe for a period of time, if, silver is undervalued relative to gold, may purchase it and then sell it, once it kind of reaches that fair value. But none offer that long-term multi-generational hold that I recommend that gold is.
Okay, you've raised a lot of really interesting points. So I'm going to try to hopefully talk through them with you. I think
Yep.
one thing that people want to know or should know more about is how exactly should they be buying precious metals? Let's take gold. Should they be buying it online? Should they buy it in person? Should they use cash? Should they use a credit card? What are the important things to know once you actually decide to make your purchase, and assuming that you're an investor who's buying it for the long term?
Okay, so if you're going to hold coins as an investor for part of that portfolio at home, which you feel comfortable owning, let's maybe work it backwards. So, if we have a client, say $1 million portfolio, 10% allocation, it's $100,000 allocation to gold. Of that, I would probably suggest maybe held 5,000 of that in coins. So that's probably today's prices, probably two, three coins, really. Certainly, there are several reputable companies online which you can order your coins from. It depends where you live. There are also precious metals shops where you can go in. There will be premiums, and that's the part I don't quite understand. Where for the other $95,000, say in this $100,000 allocation, there's a few vehicles for investors that they can hold. There are no premiums. It's virtually traded fractionally above spot. And say, for instance, right now, last I checked, the premium on gold is about 7 to 8%, 7 or 8%. So if one of these investments charges a management fee of 50 basis points and you're paying 8% above spot for a coin, that's 16 years of fees that, that you're paying in advance for that part of, human nature that wants to hold those coins. So, so I guess that's fine on that small transaction, say for $5,000, but I would never suggest for a client or anyone to hold, $100,000 of gold in their home. I just don't see how that's a wise move there. It's probably another conversation about all the ins and outs of that, but.
Yeah, so actually, maybe you can talk a little bit more about that. If you're not storing it in your home, where should you be putting your gold?
Well, home insurance, at least in Canada, it's not available for your valuables such as gold. There's safety deposit boxes if you'd like. Those aren't entirely without risk. However, it's low probability of risk. And I would say that's about it in terms of, I know actually there's a few individuals, so a few companies that have storage available in vaults that have the allocation passed down to you. However, you need you have to go down quite a few. You'll have to do a lot of due diligence on these individuals and the companies there to be comforted that that's actually occurring. So then you have your premiums you're paying plus your storage costs. As a rational investor, I think purchasing there's a good closed-end fund, and there's some open-end mutual fund trusts that only hold 100% bullion. It's fully allocated, and so when you do the due diligence on that, they're excellent investments for the long-term hold.
Okay, so an investor may want to split their holdings between physical and another vehicle in order to balance out those things like premiums and storage fees and things like that.
Right. If you're buying 100,000, I can't, in good conscience, suggest anyone hold that much at home. And I know all the reasons. I've heard them for 20 years in terms of why they want to do that. And I think there's a counterpoint for every single one of those. I think everyone has this idea of, an Armageddon, and they're taking a few coins where they're paying a pilot to put on a private jet and, haul them out of the country in some kind of crisis. And that's that mentality. I understand that. However, depending on your portfolio size, and if you have a 10% allocation, that can quickly become a massive problem in terms of holding that amount of wealth in your home.
Okay, I think that makes sense. So one thing I did wanted to bring you back to is availability. So we did see precious metals supply, especially gold, get tight toward the beginning of the year, which made it difficult for people who wanted to buy to actually get their hands on gold. So I guess the first part of the question is, what is the situation like right now? And then second part, during that period of tightness, I do think the premiums were higher. So are we at, what is the normal level for premiums, I guess is the question.
In placid times, gold premiums are 3 to 4% roughly. I think now they're 7 to 8, so they're down from what they were, say, in March and April, but still higher than normal. Silver went to a massive premium in March and April, I think as high as 60 to 70%. Again, driven by supply and demand. It was obviously a crisis, and individuals were prepared to pay that much premium for silver coins. That, again, I don't understand, because there's open-end silver bullion mutual fund trusts. There's also closed-end funds that hold silver bullion that did not show those premiums whatsoever. So you could have taken that extra 70% and applied more, had more ounces.
Okay.
If investors really want to do that, possibly if they're into this, they could buy, when premiums are low, buy the coins, hold on to them with the intention of selling it when, the market heats up and the premiums rise, and then they could sell it for that, increase in premium. Certainly many people do that as well, but again, that's a separate strategy outside the core holding.
Okay, so overall, would you say it's a good time to be buying gold right now? I know a lot of people feel that with prices so high, it might not be a good time to be making purchases. But as you're mentioning at the beginning, you were talking about people that you work with who simply are adding it to their portfolio as a matter of course. So maybe you could expand on that a little bit.
Yeah, that's always a common question is, the timing, is it too high? We've seen, it touched 2000. It was at a low of 1150 back, 9 years ago now. So it's, quite higher. I absolutely do think it's the right time. Could it go lower? Absolutely. This is something I discuss with clients ahead of time. So, and so what I do is step into a position right now. So to be without gold right now, I think would be a massive disservice to your wealth. So maybe start with a 1/3 allocation, or possibly half. And then if the price declines, add to that. So if you think of a 10% allocation, start off with 3 or 5%, and then the price goes down, then maybe top it up until you get to your 10% allocation. Just doing some back of the envelope math, the annual gold production is about 3,000 tons. And when I looked at the M2 money supply in terms of how much money is created per day, the value of that gold, the US printed in about 16 days. So 16 days of money printing equates to a full year of gold supply. That's why gold has value. So when individuals try to get cute and try to, time an entry, is at 1,800 or get it for 1,750, and they're happy about that, I really does not move my needle whatsoever, because I'm looking at the gold price in 20 to 30 to 40 years. This is a monetary system based on debt, a lot of money printing going on. If you paid $50 too much an ounce 40 years ago, an investor will be such a meaningless conversation So really focus on the fundamentals, macro reasons for owning it. And the price is, it's really not important to me right now at this price, whether it's $100 plus or minus where we're at right now.
And do you find that people are responding to that more right now? We do keep hearing that more people who weren't previously interested in gold are becoming interested right now. Is that something you're seeing?
I think gold's been denigrated for a long time in the media, and so I think individuals have to, take away a lot of the biases that they may have towards it. I had these biases. I probably worked about 3 to 4 years in researching gold myself before I understood what it was. So now I, basically, take all that, everything that convinced me that gold was a valuable asset 20 years ago. I can now discuss in about 10 to 15 minutes with clients. So they are more open to it, and especially when previously thought. Crisis like what's occurring today with COVID-19, they thought that's just something that happened in other countries. It doesn't happen here. And so there's many factors there's many new crises that could occur. And so the trouble with gold is people try to look at it as a financial instrument in terms of discounted cash flow and putting a value on it. So you have to look at it through several other metrics in order to arrive at what, say, fair value would be and what its role is. There's many academic papers in terms if you go to, I believe the World Gold Council has white papers on an allocation of gold in a portfolio over a long period of time, increases returns, lowers volatility or lowers the standard deviation, so reduces risk, and it balances out portfolios. It has a low correlation or a non-correlation at times, and it's not perfect in terms of if the S&P 500's up, if it's down 5%, gold's not going to be up 5%. It tends to lag slightly, I've noticed over the years, where it falls all at once, all assets fall, and then but a month later or so, saner heads prevail. People start looking towards these safe haven assets like gold. So it tends to track that money during this crisis.
Okay, that's great. So just as we wrap up, your thoughts on gold? You should have some. You should have physical. If you have a lot, maybe you should look at products beyond the physical. And anything else that you would want to leave our audience with as final thoughts on gold or on precious metals in general?
Several thoughts. So absolutely place, again, the amount you're comfortable with parting with at home. I know it's a very emotional investment as well. So if it makes you feel comfortable, have it at home, by all means have some, but have the bulk of it, depending on the size of your portfolio, have invested in a product that you're sure that has title to it, it's insured, and it's allocated bullion. Secondly, think of it as something that you won't sell, but you pass on to your children. And that gives you that long-term view. You're not reading, daily articles on Zero Hedge and all the bear websites and, looking for all the factors that will propel gold higher. It's not one of those investments. It's actually a long-term call option. Excuse me here. It's a long-term call option on fiscal imprudence, on the lunacy of politicians and central banks of creating mountains of debt. And it's a foundation of the portfolio. So simply hold it. When you open your statement, don't look at the price of it. Just focus on the number of ounces that you own, right? Just focus that you own whatever. It could be 10 ounces, 100 ounces, and measure your wealth. A neat little idea to kind of reinforce this is back in 1971 when Bretton Woods agreement was dishonored, Nixon closed the gold window, gold was $35 an ounce. And look back, depending where you live, I know real estate's very regional, depending on what area of the country you live in, but if you're not old enough, ask your parents. or look to yourself. What do the prices of an average house in your city cost in 1971? I asked my parents at that time, who had just moved to Canada, and they're saying they paid around $40,000 for a house. So if we round down to 35 to make the math easier, that's 1,000 ounces of gold. So if you look today, what is the value of 1,000 ounces of gold? Multiply that by a $2,000 price, you get $2 million. So that house, when I look it up on MLS or our real estate system here, it's not worth $2 million. So the purchasing power of gold has endured for that time period, and that's why you own it going forward.
Okay, well, thank you so much. That sounds like a great place to wrap it up. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul de Sousa with Sightline Wealth Management.